Pattern strategies and review of the course. I'm going to go through what we've covered, and it's kind of difficult to do all of this without redoing the whole course, which I can't do. So what I've done is I put together quite a number of slides to review many of the patterns. As we've gone through this course, I have focused on the individual pieces of each module to explain those. And here I'm going to combine all of them together as we go through the charts. So I'll be talking about individual pieces as well to review that, and some of them will be combined with some of the other, as I call it, thought building lessons. And after I go through all of this, I'm going to bring up the platform with the live charts, and I'm going to go through those charts in multiple time frames from a core and swing trading perspective, reviewing many of various stocks that I'll look at. It's probably the broader markets, and talk about all of these strategies together. And I'll also do that with intraday charts. The focus is different, whether it's swing and core versus intraday, but the concepts are all the same. Let's go ahead and go through this. I'm not sure how much time we'll be spending to go through all of this, but it'll be time well spent. All right, so here's the foundation for master trader technical strategies. As I said, I'm going to go through each of this piece by piece, and then we'll put it all together again. So uptrend defined as higher highs and higher lows. Minor support, the area of the prior high within an uptrend. Major support, the area of the prior low within an uptrend. So higher highs, higher lows. The high that preceded a pullback, that's your minor support. And the low that prices advanced from and then took out the prior high, that becomes our reference point of major support. And that is key as it relates to our trend analysis, since it's higher highs and higher lows, and the violation of major support ends the trend by definition. So their buyers will be at either minor support or major support. It says, however, the deeper the retracement, the higher the odds of the trend actually changing. That being said, until major support is violated, the trend is still up until that changes. A void is created by momentum moves, which is rapid price movements or a gap in time. Those voids are what we look for when we find a setup that suggests the direction of prices, and if the void is there, that then suggests pattern should follow through in a substantial way. Relative strength and weakness is just simply based on the comparisons of one instrument to another. That could be a stock versus the S&P 500 or the NASDAQ 100. Intraday, it could be a stock and or the S&P 500 versus the NYSE tick. And we'll take a look at that as we look at the live charts. These are just the acronyms that we go through. Sometimes I just label them with the short acronyms, but just a review of those again. We looked at this chart at the beginning, and I said, go through and find different setups. And this is what I'm going to do when I bring up the live charts, and we're going to do it in multiple time frames, just looking for the setups. And I'll review the different setups that we look for. And as I've mentioned it somewhere in the course, we are, by definition, price pattern traders. So we look at price patterns and we put that in combination with trends and multiple time frames and relative strength and weakness, market internals, some intermarket analysis, and that all comes together for a high probability trade. So the patterns are starting points. One of the pitfalls of being a pattern trader is seeing the pattern. Well, I guess that's initially a plus, that you can see the pattern. However, seeing the pattern, which does suggest a direction, to say, did I apply the various concepts together? Because once you see the pattern, it doesn't necessarily mean that you want to take a position. And you say, well, why not? Well, because you can have a bullish pattern develop within a downtrend so that you don't place a trade, or what I would call an impulse trade. and that's part of the psychological hurdles that we deal with. You need to become familiar with the method so that it becomes second nature. So the thought process happens instantaneously, where you see the pattern and you automatically say, did I, you don't go through the thoughts, but they just happen instantly. That's what second nature means, is that it all happens virtually without thought. But you look to the left, you look at your multiple time frames, you consider what the broader markets are doing, and so on. So as we look at this chart and say, well, we'll see a buy setup here, which is just a pullback here toward an area of minor support, and you get bottoming tail bars that moves up. And here's a perfect example of a situation where, for whatever reason, we don't have the information, but for whatever reason, this great looking pullback pattern here with these bottoming tail bars didn't go very far. And that could have happened. Maybe there was a giant volume spike, or possibly at that time this was showing relative weakness and it just began to move at that time, and then the market pulled back. We don't know. What we want to take away from this is that even great looking patterns, for whatever reason, at times, they're not going to go as far as we may have thought that they would. That's how we manage. And this is a great example of, there's no doubt we would have been stopped out with a stop under here, unless, of course, we went with half the shares and twice the stop, which we covered in the management section. And then we would have held on through this. And that, I will tell you, is easier said than done because of this choppy type of price action. Now, if you can detach yourself from this, that is part of your goal. And it's saying, well, my stop is down here. I've calculated my maximum loss in an area lower, and that could be down here, your next reference point of support. And then, sitting through this isn't easy, to be watching these kind of a pullbacks, and then as you see prices recover, and it certainly looks like they can get through here, and that would be the exact thought. If it can get through here, I'm back off to the races. And on this bar right here, this is the snake in the market, so to speak, that bites. Right here is when it's dropping and it takes out the stops. Here's our shares right there at the bottom, at that bottom tail. If we didn't calculate the management for it, because if it was under here, we have to exit. That's the plan. Now, can you get back in on this reversal? That is a little bit of a mental hurdle, but that is the goal, to see something like this and shake off being wiggled out. And if you're not in it, it's a great setup right there. Bottoming tail and a potent reversal here, and it should go up, and you're going to be looking if there's a void. And here's a nice push up and a continuation pattern, a 180 type reversal. And if we were to condense these 2 days, we could have a bottoming tail or a money bar. I'm going to show a slide on that. But money bar setups happen after an initial move. So here was a period of consolidation, and then prices pushed up, and we have a continuation pattern. And while we didn't really talk about this, and I'll talk about that a bit as we go through the charts, but this is a measured move type of setup where you have an initial move, a quick correction and reversal, and then a move relatively equal to the first move. Don't know why it happens, but I've seen it 1,000 times over the years. And it's just a guide as to what is likely to happen as far as a target area, this measured move type of setup. There's another choppy type of reversal in a wide range bar, reversing to the downside, big bearish bar. Now, that does suggest or signal that prices should move lower. However, your major support is down here. So the trend, this pullback does not violate the trend, pulling back and, drops down and bottoming tail, which says, hey, here are buyers. Do I want to buy this bottoming tail bar here? Not with a full position size, because it's too far away from support. Can I do it? Yes, half the shares, twice the stop. There's nothing to say that in any given day that this kind of a pattern couldn't follow through to the upside. if momentum is really strong, the markets are strong, a pattern like this can follow through. So that's something that you would have to assess in that particular market environment to see, does that really make sense to do? It isn't where I can tell you that when you see this, just press the button every time. I can't. Part of what we do is gaining, as traders and investors, is gaining experience with different market environments and being able to make that decision. In any event, a move of this extent, half the shares and twice the stop, for me, would always make sense. And then here on the second turn, and I'm going to cover this pattern with you, the lower high, lower low within an uptrend, that is definitely an entry point where you would want to add the second part of your position. And as prices move up and you see momentum beginning to slow down, and over here, the distance at this point is much less high to high than it is here, high to high. So momentum is slowing down. You'd have a momentum type divergence. Indicator users would say, hey, look at my stochastic or RSI or whatever it might be showing the bearish divergence, and then prices pulled back. You don't need any of that. What you need to do is just observe these moves, and once it makes a new high, if you get a red bar in an uptrend, you know that the momentum is slowing, and you can see the small candle bodies here, that the momentum was slowing, and then it broke down below this swing low, which is major support. So as this moved higher, and then here we have a swing low or a pivot, major support. Now, I covered pivots being a pivot bar with 3 higher lows to the left and right. This one only has 2. So you can call that a minor type of pivot. And once it moves significantly, I would call, and that's kind of a subjective term, but 3 bars up, or the distance here away from that pivot, it's created a little minor support, is definitely a reference point that I wouldn't want to see taken out. But it does not meet the definition of our trend following pivot, but our money management pivot. We would bring the stop under here. In our position and money management section, I said 2 higher lows to the left and right. After a move, I would then bring my stop under here. And we continue to do that. Stop under here. Momentum is slowing down. The next question is that you should be thinking, and that should become second nature as well, why? Why did it happen? Well, it's moved up a lot, but what's moved up a lot could move up a lot more at times. But what's to the left? Is it at an area of price resistance? And even in a higher time frame, this could be a daily chart, and on the weekly or monthly chart, this could be coming up into resistance within a downtrend. We could still play this at the appropriate time. For example, the monthly is a climactic buy, and this has had a nice move up where we follow the trend and the patterns on the daily time frame. And as this come into resistance on the higher, well, I know the expectation for momentum to slow down and the trend to reverse would be at hand. So all of this comes together as you put all of the pieces together of what we've covered in the course. So the foundational components are technical investing and trading. Price is king. Everything else is secondary. The candlestick analysis, trends, multiple time frames, support, resistance, volume, relative strength and weakness. I don't have it on here, but of course you would do that. And what's happening in the broader markets, all of this comes together to form our master trader technical strategies. And I don't care what you trade, all price movement happens because of traders, you and I and hedge funds and mutual funds and whatever is out there. It's all people trading that, and they react in the same way, whether it's greed or fear or indecision or confusion. It all is reflected in the same ways regardless of what you trade. So the basics of candles. We look for wide bars and narrow bars, and the narrow ones tell us momentum is slowing, and the big ones tell us that momentum is increasing. And it's all about, is it an igniting wide bar or is it an ending wide bar, whether it's bullish or bearish. Topping tails, sellers took control, bottoming tails, buyers took control. When we look at bottoming tails and topping tails, the next question is it also a range expansion, topping tail or bottoming tail? Because wide range bars are either igniting or ending, and bottoming tail bars are just another form of when it's a range expansion bar, a wider bar, but it turned around. So a big red bar and a climactic move to the downside that turns into a bottoming tail, which is also would be a range expansion bar, would tell us that buyers took control and the odds are extremely high that prices are going to move up. Because I referenced a climactic buy setup, the ideal scenario for me, as I look at climactics, I prefer a retest and failure or a W type of a pattern. So a pullback after an initial move up back toward this big bottoming tail bar, which could be followed by a smaller bottoming tail bar. And of course, we'd be looking at volume. All of that comes together for high odds trades. Now that climactic bottoming pattern on the daily with a monthly uptrend, for example, or into significant support, you see how we're putting all of this together? And as we do that, the multiple time frames and the patterns and the volume and such, the odds are overwhelmingly in our favor. So let's look at some of the patterns here. Don't get caught up in the exact thinking of the patterns. Uptrend patterns. These are the foundational 4 type of patterns, just pullbacks, a bullish flag. In other words, it goes up and it kind of corrects, sloping to the downside a little bit, looking for a continuation move higher. And these are just the bearish ones. Your retest and failure pattern, your W type of a pattern, or M type of a pattern, or just a base, a well-defined base. How do you define a well-developed base? You kind of eyeball it. One of the ways is to just see if it has moved up already. If it's in an uptrend, it goes sideways into a 20 MA. You could say, well, what if it goes sideways into the 10 MA? Well, generally, that would be too short of a moving average. The 20 just works better. So it's just a guide, a visual aid, and generally it works well, and that's why we use it. Oh, trend trade, pullback and reversal. And this is your basic type of trend trade. Prices have moved up, pull back a little, they exceed the high, this becomes minor support, this becomes major support, and as it pulls back into that area, this is where buyers should show up, and you look for that reversal to happen. It's like, could it form a W here? Well, absolutely. It isn't always going to pull back in this perfect way. It could come up a little bit and come back down a little bit, and once it does that, it is then created a new pivot and reference point of support that wasn't there before. As prices pull back, this is my reference point. As they complete the pullback and begin to pivot, it's created a new reference point for me to focus on. Whether it pushes up like this or it stalls and comes in, I can use this as a place where I could add to the position. It might poke under here a little bit. You'll have to see how it develops. We can look at all of these patterns, but we don't know exactly what's going to happen in the moment. And that's part of, we talk about, you have to be able to operate in a state of not knowing, meaning ultimately you don't know exactly what's going to happen, but you're okay with that. You have a method to continue the analysis. Now, as prices pushed up here, we see the range beginning to expand, wider range bars. It's getting a little far from the 20. Odds are momentum stalls. It pulls back. It could go sideways. Now, what if it went to minor support? Well, that would be okay. Ideally, it would go sideways and create new support and then go higher if it was within a void. And that's one of the things that you would look for. Is it within a void? But it could pull back into this minor support area. And ideally, ideally it doesn't pull back too deep, because the deeper the retracement, the greater the odds that it could break the trend. Counter trend trades, they're just getting extended. So you can see the distance from the 20 MA. Here it's relatively close, and then prices continue higher, where you would think, hey, this will pull back a little bit. Maybe it pulls back to minor support. I get an entry point or somewhere in between minor and major, and you get a reversal. But it continued to move higher and becomes what we call climactic, where it's getting far away from the 20. I say, well, how far away can we measure it? Which is a great question. And my observations by just creating a basic indicator or gauge, whatever you want to call it, that just shows the percentage difference from that 20 MA. There are times where it works and other times where it just doesn't, and prices become more extended. You can look at the recent history of the past to see how far it moved away from the 20 MA as a guide. But different stocks and different market environments will move further away than other times or not so, especially in a choppy market. But looking for that far distance from a 20 MA is one starting point. Now, while cover or look at this type of thing as far as charts go, is what's called an ADX indicator. What it does is it measures trend strength. It isn't something to put on your chart. However, it is something that works well in scans, and this is where indicators are useful in scans. So one of the ways for looking for extended stocks, besides just a percentage difference from a moving average, which is a starting point, and of course you could say multiple bars moving up in a row, but that ADX indicator, if you tell your scanning software, as part of my criteria, I could say it's a certain percentage from the 20 MA, it's up several bars in a row, and the ADX indicator is in excess of 50. Doesn't happen too often. So you may have read in the past that trend following systems will use an ADX indicator to say prices are trending up, however they want to define it. Prices are above the 20 is above the 50 is above the 100 is above the 200, the 20 MA is sloped to the upside, and so on. And the ADX indicator is above 25 or 28. You could go with something like that, and it'll show you stocks that are trending. There's a lot of ways to use software to find stocks that are trending or markets that are trending. That being said, over the years, seeing stocks that have exceeded 50 or even 60 value of the ADX indicator have been extremely extended because the trend has been so strong. And what you see is that a pattern like this, where it's trending up strongly and pulls back very little, and that's just part of how it's calculated. So I just mentioned that as an idea in scans, and I'm going to show you what I use for scanning. Climactic patterns, it says counter trend. So here its prices are far away from the 20, and what I'm showing you here is to observe this from the point of view of this being an intraday chart. And I say, well, where is this happening? Is it into resistance? What do multiple time frames suggest? So a climactic sell setup, and I'm looking at all of these here from the long side that we've been looking at so far. You just turn them upside down, for the climactic buys. So what happens next? Well, it should pull back. But here I'm showing you the daily chart is a huge wide range bar to the upside. So I'm putting this pattern in the context of this move beginning here. So if I'm going to trade or this counter trend trade, this climactic, I'm putting it in the context of what here on the daily, and my expectation is I don't expect this to collapse sharply because the size of this bar here suggests it's just getting started. And yeah, it might pull back, so I could use this as a scalping strategy, but it isn't something where I would anticipate the end of the move on the daily time frame. Now, if it looked like this on the daily time frame and the intraday looked like this, the odds are pretty good that this is going to pull back in a significant way. It should. Now, what happens here, it could form an M top. You could say, I'm going to wait for this to pull back and make a lower high. There are choices here as how you're going to trade this. Some might just short it right under this low, and you could get a nice pullback. That is part of your trading plan for you to decide how you're going to trade a particular setup. There's a lot of different ways to do it, and part of it is, what are you comfortable with? Can you short it under here with this pattern? Sure. Since it's still in an uptrend here on this intraday time frame, half the shares, twice the stop, look to add at the appropriate time. This is what we do. So reversals after a void at resistance. Now, this type of a pattern, this is showing like, to say this was a big move on the daily chart. And here's a gap down, and prices eventually got up into that area of resistance, which could be an unfilled gap. And this is where I would look to sell short. And this is making a higher low and a higher high, but this is exactly where it should roll back over. And it's the same type of situation here as with the climactic. Do I short it right here? This would have pretty good odds of shorting it here. And what would increase the odds? If this was a topping tail bar, or topping tail bar, and maybe it moved up in a red bar here. So as prices go sideways, over time it builds up a larger area of resistance. But shorting it here is very okay, because you're doing it at the appropriate moment. And notice the 20 MA is pointed to the downside. It's in a downtrend. Now, this example is one in which it does not get up to resistance. And under those conditions, or that scenario, I wait for the M top. I don't short the first reversal, not without half the shares and twice the stop. But this type of a move, I want to see it create this resistance area, which is still within the void. And you see that here, I'm showing you the distance from the 20. It hasn't filled the gap here. And this could even be a climactic pattern to the downside that then reverses. And a climactic buy setup, I never short the first reversal, and I never short the second reversal either until it forms an M top. It has to create a new resistance area once that happens. Multiple time frame trend trade. What I'm showing you here is a higher time frame, which is still making higher highs and higher lows, and the higher time frame is pulling back. This could be a weekly. And then on the daily, which has had a move, maybe it got a little extended here, it begins to pull back, makes a lower high and a lower low. As it gets close to this support area, that's where you're looking for the reversal, where these time frames are lining up, where this should turn into a red bar transitioning into a green, and over here is where that'll happen. And that could happen, this is weekly and this is daily. This could happen over the course of 4 days, 3, 4, 5 days, whatever it might be. Could have a bottoming tail bar here. Could happen so many different ways. So as we look at this, it's to prepare based on the higher time frame uptrend, even though this has made a lower high and should be a lower low as it pulls back in here. I'm anticipating this being the lower low and then the reversal, which starts to move up. It'll probably stall here because that's resistance, but then it'll continue to move up because the higher time frame is in an uptrend. And when prices are in an uptrend, the assumption is that the trend will continue. That's part of what the things that we assume when we look at uptrends, is that they'll continue until they stop, and downtrends will continue until they stop. And they typically stop once they reach some reference point of resistance, right, in an uptrend, or it creates that resistance, and that could be in the form of an M top. It could be in the form of a head and shoulders top. It's some type of a distribution pattern, and in a downtrend, that happens in the same way, whether that's a W pattern or a head and shoulders type of a pattern. Now, stocks that have been in long-term downtrends, they typically take a lot longer to form those bottoms, whereas the tops take a shorter amount of time, especially after they get in a climactic move higher. Okay, let's move to